Hi everyone, welcome back to Accountant's Desk. In today's video, we will learn about subsidiary books in a very simple way. If you are a student, small business owner, or anyone who want to learn about subsidiary books, this video will be your one-stop solution. You will understand what subsidiary books are, why we maintain them, difference between journal and subsidiary books, and different types of subsidiary books with examples. By the end of this video, you will have absolute clarity. So let's begin. Meaning of subsidiary books. First, let's understand the meaning. Subsidiary books are special journals maintained in accounting to record different types of transactions separately. Instead of recording all the transactions in one book, that is, the journal, we divide them into categories like purchase transactions in purchase book, sales transactions in sales book, and cash transactions in cash book, and so on. In the previous videos, we learnt about journals. Journal is the main book. Under journal, there are subcategories. Those are called as subsidiary books. Importance of subsidiary books. Saves time and effort. Transactions of similar nature are recorded in one place. For example, all the credit purchases in purchase book, all the credit sales in sales book. No need to write everything in journal. Reduces errors. Division of work avoids confusion. Each book deals with specific type of transactions and it improves accuracy. Easy to track transactions. If you want to check only sales or purchases, you can directly refer to that book and it saves your time during audit or checks. Helpful in preparing final accounts. Balances from subsidiary books can be easily transferred to the ledger, so it speeds up preparation of trial balance and final accounts. Specialization of work. Different clerks or accountants can maintain different books, like purchase book, sales book, that leads to efficiency and expertise. Provides detailed information. Each type of transaction can be analyzed separately. For example, total credit sales in sales book or how much was returned by customer. It helps in decision making for management. Difference journal versus subsidiary books. Method of recording. In journal, all types of transactions like cash, credit, returns are recorded in one book. In subsidiary book, each type of transactions are recorded in separate books like cash book, purchase book, sales book. Time and efficiency. Journal, it is time consuming as every transaction is written with full details. Subsidiary book saves time as only similar transactions are grouped and recorded. Accuracy and errors. Journal, there is more chance of errors since everything is in one place. Subsidiary books, it reduces errors as work is divided into separate books. Specialization of work. Journal, usually maintained by one person, and subsidiary books, different people can maintain different books. Example, cashier for cash book, purchase manager for purchase book, and so on. Suitability. Journal, best for small businesses with fewer transactions. Subsidiary book, best for large businesses with frequent and numerous transactions. Types of subsidiary books. There are 8 subsidiary books you need to know: cash book, purchase book, sales book, purchase written book, sales written book, bills receivable book, bills payable book, journal proper. We will go through each one step by step. Cash book records all cash transactions, that is, receipts and payments. For example, paid rent with cash, received cash from customers, and so on. Types of cash book. Single column cash book, that is, to record transactions related to cash. Double column cash book records transactions related to cash and discount. Triple column cash book records transaction for cash, bank, and discount. And petty cash book, it records small day-to-day expenses such as postage, stationery, fee, and so on. Next, purchase book, a special book to record all credit purchases of goods. Remember, we record only credit purchases here, and cash purchases we record it in cash book. If you buy assets like furniture or machinery, it is also not recorded here because it is not goods. Only those transactions are recorded that we purchase for sale. Example, purchased goods on credit. Sales book, a special book to record all credit sales of goods. For example, sold goods on credit to Mr. ABC. Here we record only credit sales. If it was a cash sales, then we would have recorded in cash book, not in the sales book. Purchase return book, that is returns outward book. That is, while purchasing the goods, if we have purchased it on credit and now we are returning it to the suppliers, those transactions are recorded here. Okay. If we have purchased the goods on cash and now if we are returning those goods, it is not recorded here. It is recorded in cash book because it is not credit purchases during the time of purchase. Sales return book, returns inward book, records return of goods previously sold on credit. Here we record only those transactions if we have sold the goods on credit and if the customer has returned those goods now. If we have previously sold it on cash basis, then we will not record it here in sales return book. We will record it in cash book. Only because the transaction is credit sales return, we record it in sales return book. Bills receivable book records bills of exchange accepted by customers, that is debtors. Let's say the customer buys the goods from the business and promises to pay in 15 days. This is bills receivable because the business will receive money. In simple words, when the customer accepts the bill and agree to pay us after a certain period, we record it here. That is called as bills receivable. Bills payable book records bills of exchange accepted by the business. Let's say if we purchase goods from the supplier and promise to pay in 30 days, it is called bills payable because we need to pay to the supplier. In simple words, when we accept a bill and agree to pay the creditor after a fixed time, it is recorded in bills payable book. Journal proper records transactions that do not fit in any other subsidiary books. Example, opening entries, closing entries, adjustments, rectification, and transfers. When a new business starts or books are opened for a new accounting year, balances of assets, liabilities, and capital are recorded in opening entries. And at the end of the accounting year, nominal accounts, expenses, and incomes are closed by transferring them to the profit and loss account. These are called as closing entries. Adjustments made at the end of the accounting year for outstanding, prepaid, accrued transactions are recorded in adjustment entries. Rectification to correct errors recorded in accounting transactions. Transfer entries transferring balances from one account to another account. These all are recorded in journal proper. So these are 8 types of subsidiary books. Cash book records all cash and bank transactions. Purchase book records goods purchased on credit. Sales book records goods sold on credit. Purchase return book records goods returned to suppliers, that is purchased on credit. Sales return book records goods returned by customers that are sold on credit. Bills receivable book records bills the business will receive. And bills payable book records bills the business has to pay. And journal proper records all other transactions not in other books. So that's it for today's video. If you found this helpful, don't forget to like, share, and subscribe for more simple and practical accounting lessons. And if you are a small business owner looking for professional bookkeeping support, just fill out the Google form linked in the description. Thanks for watching, and I'll see you in the next video.